listening to Pre-Market Prep. I'm Brianna Valesky here with Joel Elkanah, and we have Todd Sullivan on the line. He's the founder of Rand Strategic Partners, a long-short hedge fund. He's also the author of ValuePlays and an angel investor in Estimize, DailyWorth, Mile High Organics, and more. Todd, thanks for joining us. How are you doing on this Friday morning?
Very good, thank you. Hope you guys are doing well out there.
Absolutely. Well, we're watching these markets just like you have been. What's your take on how they've been acting with all of these news coming out of Greece, China, Puerto Rico, tons of macro action happening?
So, if you look at the Greece situation, to me, the way I look at it, Greece is a giant game of chicken, right? And it seems, based on the news we heard last night, that the two sides are realizing that a Greek exit is not beneficial to either party. Mm-hmm. And in fact, it causes a lot more distress for both of them over the longer term. And it seems like last night, both Germany and Greece sort of blinked, and that they'll probably come to some sort of arrangement that is not ideally what either one wanted, but for both parties in the EU in general, is just fine. So I can't get too excited or nervous about what's going on with Greece. If you really even take a step further back, Greece is the equivalent of Connecticut, right? That's their GDP is about the same as the state of Connecticut.
Exactly, very small.
So yeah, so you have to, and they don't really make anything. Their GDP is basically tourism. So you have to look at it. Would global markets be falling apart if Connecticut was in financial distress? And the city of Detroit had problems where global markets falling apart. No, it's a small piece of the pie. And I think it's been a while since we've had any correction in the markets of any significance. And I think something like this is pretty much the excuse for people to maybe pack up. You have the uncertainty around Greece. You have summer months coming up, which, July is typically a volatile month. You put those two together, an excuse for people to kind of pack up and go home for the summer. So as far as longer term in the markets, I can't get too excited about it. It did present some great opportunities, and, being a longer term investor, I look at these, events like this as, like the Black Friday sale. It's one week or 2 week event. Everyone panics and things drop to valuations that just don't make any sense, and you get to pick some stuff up on the cheap, and then things get worked out and the markets recover. So as far as China goes, the China markets have 72% in the last 12 months, give or take a couple. This was as of a few days ago. Mm-hmm. 12 months ago, if I had told you, buy this market, you'll be up 72% in the next 12 months, you'd be thrilled today. But, we only tend to look back over a 2 or 3 week period when we're looking at results and things. And because it's fallen a lot, down to 72%, people are completely worried. So, China's an immature market. It's going to have these, large swings in either direction. But, the China economy is still sound. The China economy is still humming along. Is it growing at 8, 9%? No, 6, 7%. It's huge. Eventually, the growth rate has to slow down. And its markets are going to kind of figure things out accordingly. So, again, I just can't get too worked up about that as something that's going to cause a fundamental downshift in the U.S. economy, which would then be a negative for U.S. stocks, again, over the longer term. Over the next 2 weeks or 30 days, who knows what's going to happen. But I'm looking a year down the road, none of this really shakes my confidence of what is coming up.
But when you're comparing like China to Greece, China is just massive, enormous amount of GDP when you compare the two of them. So, but you still don't think there will be a huge global impact from what's going on in China's stock market right now?
Well, I think if you look at the China stock market as with a direct correlation to its economy, then yes, you would be nervous. So let's not forget, that market rose 150% in a year. Mm-hmm. So the rise in that market far exceeded the fundamentals of the Chinese economy. So if you look at it from a fundamental standpoint, either two things have to happen. Either that market has to recede back to a more rational level with the China economy, or the China economy is in fact growing 150% in 12 months. We know that's not happening. So this market has to adjust back to a more reasonable valuation at some point, and that's what it's doing. If people look at the U.S. stock market, the U.S. stock market is a reflection of the fundamentals of the U.S. economy, and too often I think people reverse that and say, if the market falls 10%, it's because we're going into a recession. Well, how many times have you heard that the last 5 or 6 years? And
right.
That's never happened. So I think too often the equation gets flipped, and people tend to look at the markets as an indicator of what's going to happen in the economy, and the markets are following the economy. So.
Okay, so let's take a look at some issues closer to home. We are entering the next earnings season. We had the unofficial kickoff with Alcoa reporting earnings this week. Not as good as expected, but many people, I think, don't even view it as a bellwether for the entire stock market anymore, so we just kind of breezed by it. What specific issues are you watching right now in the U.S.?
Well, I think expectations for this earnings season are pretty low. So I anticipate we'll come out looking good, and that we'll have overall more companies there'll be a decent percentage of companies that beat their expectations. Companies have gotten pretty good at setting the bar to a point where they can easily beat the expectations they set for the analyst community. So I think that's where we're at. I think the economy is doing well. It's not going to be growing 4 or 5% by any stretch, but every major indicator that I look at is heading in the right direction. Retail sales, job openings, hiring, employment, temporary employment, everything is moving the direction it could. The last real area of the economy, and we've talked about this before, to recover is housing. And we're starting to see signs over the last 3-4 months that housing is starting to kick into another gear. And I think if we start getting some significant growth in housing, especially in new housing construction, then that will lead to some significant economic growth in the second half of the year. Now, it's a little early to tell if a lot of this, what we've seen this spring and early summer, is catch-up from the brutal winter we had in a lot of areas, or if this is, in fact, another leg to the upside for housing. I tend to be of the opinion that it's another leg up for housing. I've maintained, and I still maintain, that once we start to see interest rates rise, that housing really starts to accelerate. And the reason I think that is because right now the lower end of the credit spectrum.
Todd, are you still there? We may have lost Todd. Hold on with us, guys. Let's double check and see if we've still got a connection with him here.
Wow, we're trying to...
Can you hear us, Todd? Yeah, we got you back. All right, so you were talking about... Go ahead, keep talking about housing and interest rates.
Yeah, I think that interest rates being so low, and we know this when we look at all the data, the lower end of the credit spectrum and first-time home buyers have really been shut out of the housing market. And that's because lender spreads are just, they can't go out on that risk spectrum because of the spread of interest rates. And once we see interest rates start to rise, I think banks are going to open up that spigot to the next section of potential borrowers for homes. And I think that's going to be a lot of your first-time borrowers, a lot of your people who lost homes in 08, 09 are going to come back into the market. And the whole mental thought process of, if rates are going up, I got to get in the housing market now with potential buyers, is going to kick in. And I think you really start to see housing accelerate when we start seeing small rate increases from the Fed, and that gives the banks a little more breathing room. I've said this for quite some time, and I still believe it's going to happen. We've seen interest rates rise. We've seen increased activity in the housing sector. Obviously, 2 or 3 months, we can't say that that's a new trend or whatever. We need a little more confirmation, a little more data. but I think it's starting to happen, and I think we really see it start to happen as the rest of the summer and the fall. And once housing kicks in, the economy in general really starts to get going. So I'm really optimistic for the second half of this year.
What about the Fed? Do you think they're going to have enough confidence in the economic indicators they've been seeing to give us a rate hike this year?
I hope so. I mean, I am of the opinion and have been that we need a rate hike. I think, I'm not going to predict what the market does if it throws a tantrum the day the Fed comes out and says we're going to raise a quarter point or a tenth of a point or something. I don't know what the market's going to do that day or that week, but for the Fed to come out and say we have enough confidence in the economy to raise rates, I think over time will be a huge boost to the mentality of a lot of Americans who look at low interest rates as we're still teetering on something bad. And once the Fed comes out and says, all clear, we're going to raise rates, I think you get a whole mental turnaround in a lot of businesses, a lot of people, a lot of lenders, a lot of potential buyers for products and goods. And I think that happens. I really hope they raise it. They seemed to be, I'm not going to predict whether it's June, July, August, September, October they raise them, but I have to think before the end of this year they do something. Because I think even they have to see the credit situation and see the correlation to that and low rates. I think that they have to see it. So I hope they do, and I anticipate they will. I think there'll be one raise, and they're going to sit for a while, make sure that everything's okay before they raise again. I don't think you're going to see a series of interest rate rises, but I think you'll definitely see one, and I think you'll probably see it, sooner rather than later, meaning, late summer, early fall.
What happens if they don't raise rates this year? I mean, some people like Peter Schiff have said they've reached a point that they can't even raise rates. Other people are arguing that a rate hike is already priced into the market. What do you think is going to happen if we don't see a rate hike in 2015?
Well, I think you've seen the interest rates come up. You've seen a lot of rates come up recently. So I think the market is trying to price in an interest rate hike. Mm-hmm. I think if the Fed doesn't, we continue with this, 1.75 to 2.75 GDP growth. We just kind of continue to just sort of trudge along. Nothing spectacular, but I think we just get stuck in this sort of malaise where, no one has a lot of confidence that the economy is as good as maybe they think it might be because, a lot of people assume the Fed has all the best data, so if they're not confident, why should I be? But I see things getting better, so I'll make some very conservative or safe investments in my business. I'm not going to go out on a limb because something must be happening out there that I don't see. So I think we just continue in this, unspectacular, boring sort of growth. I think if the Fed wants to kick it up, then they're going to show they have confidence in the economy, increase some rates, give the banks some more lending spread, and let the banks fund. I mean, lending, it needs to increase to a whole demographic of people that right now are shut out of it for the economy to really get going. And, these people deserve to be able to buy a house. They're spending $1,300 a month for rent. They can spend $1,200 to pay for a home, but they can't get the credit right now. So I think there's more risk if they don't raise than if they do.
Okay, let's talk about some individual issues. And before we got live on the show, you mentioned AIG. Are you watching insurers in general, or is this one that just kind of sticks out to you?
Well, I've in full disclosure, I've been a shareholder in AIG for a few years now, and the biggest risk in AIG over the last year was Bob Benmosche. Obviously, was sick and sadly passed away. He was the rock star CEO of the insurance industry. He single-handedly brought the company back from extinction when it was in liquidation mode, turned it around, made it, it's a powerful insurer again, and he deserves credit for that. His successor, Peter Hancock, was known, but, you never really know how someone's going to perform until they're head of the company. And he's been making comments recently that when you read him, if you didn't know who it was who made these comments, you'd swear it was Buffett.
Really?
He's made comments about the stock. What?
I was saying, really?
Yeah, I mean, he's made comments about the reinsurance market, how it's been softening. A lot of a lot of hedge funds, PE firms have put money in the reinsurance market because it was easy money for a while. So rates have started to collapse and the risk level is going up. And he's come out and said, we'd rather give up market share in the reinsurance market in bad pricing environments, put our money someplace else. And that is virtually verbatim from some of Buffett's shareholder letters when he talks about reinsurance. And in fact, I think it was either early this week or late last week, Buffett made similar comments about reinsurance at Berkshire Hathaway, how they were pulling back from the reinsurance market because the risks are growing because pricing is collapsing, and he's perfectly happy to give up market share to preserve his business and preserve his pricing and work at an underwriting profit. And that, for the CEO of AIG to be thinking the exact same way as Buffett is on insurance, so I think most people would agree, when it comes to insurance, Berkshire is a first-class operator, has to be music to shareholders' ears. I mean, when Hancock talks about the business, he talks about the intrinsic value of AIG, growing book value per share, and these are all things that you've heard Buffett talk about at Berkshire Hathaway over the years. So his actions and his words, I think, have to be just lovely for AIG shareholders to hear because he's truly operating the business for the next 5, 10, 15 years, and he's truly operating it to run it at an underwriting profit, not for the sake of showing, increased revenues every quarter, which may turn out to be extremely bad revenues to get when you have a catastrophe, you have something that the reinsurance has to pay out on, and you haven't been adequately compensated for that risk. So he's turning out to be, I think, the perfect CEO for AIG. I think over time he's going to be, probably thought of as one of the best CEOs in the insurance business behind the Buffett, behind the Desmoshe, simply because of the way he operates that company. And the metrics he uses for success aren't just growing revenues every quarter, it's growing intrinsic value and book value of the company. And that's just a wonderful thing for an operator of an insurance company to be looking at.
Todd, we've only got a few minutes left with you, so I'd love to talk about some of our bellwether stocks. Apple made a pretty low close yesterday. I think it was since March. It was its lowest close. Haven't seemed to put out any home run products since Tim Cook has been CEO. Besides the iPhone 6, the Apple Watch has had a less than it's had an enthusiastic launch, but it hasn't just been a hit it straight out of the ballpark. What are you kind of seeing on the long term for Apple right now?
So I'm an Apple shareholder, and my view is that I think the Apple Watch, the view that it wasn't an incredible launch, I think is partly because of the expectations people have for anything Apple launches.
Sure, right.
I mean,
That's a good point.
if Apple launches a product, if there aren't lines around the block to get it, a 4-month waiting list at the Apple Store, and people aren't, selling them on the black market for 3 times their value, the launch is a failure. Well, the expectations are massive. I think it's the first generation of the watch. I know a few people that have them. They love them, and I think it's like anything else Apple does, it's only going to get better. I think the real thing that I'm looking at with Apple is the next generation of Apple TV. The deals they're making with some streaming services. If I look at myself, my own viewing habits, with my Apple TV, I can watch Netflix, I can watch the NHL packages, I can watch Showtime, HBO. Most of my viewing habits I can view through the Apple TV. So I'm starting to get to the point where I look at my cable company and I look at that and I say, why do I need you? And I think that the next generation of the Apple TV, I think may start getting that point where people start saying, I don't need my cable company anymore. I can subscribe to what I watch through my Apple TV. Now, obviously, the big deal for Apple TV is local channels, right? So if they find a way to get local channels through that, I think all bets are off and you have a product. But, I mean, Apple's biggest problem, right, is what to do with its cash. And if you can invest in a company that's buying back its stock, produces more cash really than it really knows what to do with, and is using that cash to buy back stock, and its products are just loved. And I think over the longer term, anything like you've seen the last week or so with Apple, you just go ahead and buy it, you tuck it away, and you'll count your money later. I mean, it's just they're just a monster right now, and they're operating at a really high level. And even the new iPhone coming out this fall, you're hearing reports of Apple ordering a record number of them because of the demand they anticipate. And it's become an event when they launch a product, and not many companies right now that I can think of have an event when they launch something. It's just Nike comes out with new sneakers, great. The new shoes are great. Under Armour comes out with a new product, that's cool. But it's not this media event when they launch their products.
Yeah.
Yeah.
Okay.
So
All right, we've been on the line. Can you still hear us, Todd?
Oh, yeah.
Okay, all right. Well, it's 9:41. We've been on the line with Todd Sullivan. He's the founder of Rand Strategic Partners. That's a long-short hedge fund, talking everything from China, Greece, to insurance and technology. Todd, thanks so much for joining us on the show this morning. Have a great day and have a great weekend.
Thanks, you too.